Orlando. I'm just going to keep talking. We are finally live. So, you guys, welcome back to Real Estate Mindset. This video and live stream is going to be absolutely bonkers. I have Orlando Miner with us. Sir, how are you?
Good. Yourself?
Good. Thank you. A lot going on. So,
Yes, sir.
what Orlando and I are going to do today, guys, is essentially go over the recent speech by Jerome Powell and kind of unpack that because there's a lot of, we believe, maybe preconceived notions about what's going to happen next. So we're going to play that speech for you. And obviously, guys, the reason I have Orlando on my channel is I don't know how many of y'all know, but Orlando is an absolute beast mode genius real estate extraordinaire. This man has helped me understand how to invest and just how to be a content creator. Orlando, brother, I just want everyone to know on record, thank you for making me a better person. I just want to say that, man.
I appreciate that, man.
And
I appreciate that.
That's from the bottom of my heart. Now, guys, do us a favor, like this. I know it's a live stream, but like this. But let me plug Orlando's channel. Here's Orlando's channel, Orlando Miner. He's got some good stuff, guys. Especially if you're, you want to learn how to buy real estate. Right now, we're sounding the alarm. I'm starting to see some comments. What's up, guys? We're sounding the alarm, but go to Orlando's page and check it out because it's got great stuff. Orlando's a great friend. We talk all the time. His information's solid. So, Orlando, before we begin, sir, I'm going to kind of just tee up this video. Do you have anything you want to say?
No, I mean, I appreciate you bringing me onto your platform and this is going to be exciting. I'm pretty sure, like I said, I haven't seen this video myself, so I'm pretty sure it's going to have some juicy stuff all in between the lines type of information. So I can't wait to commentary on it.
Oh yeah, man. So I got some stuff bookmarked. I just wanted to pull up Bulldozer's comment real quick because he's like, Powell did not flip. I agree. Yes, Powell did not flip. That's why we're here, because there's a lot of people, it's time to invest in the markets. It's time to da-da-da-da. So we're here to tell you guys on how Powell is not flipping and how he's very clearly telling us what's happening. Now, obviously, I've listened to this and studied it. Orlando, I know you haven't. Okay, so yeah, I'm going to pull this up. All right, I'm going to pull this up, man. And the first segment of the video, you guys, is going to be a few seconds, and then I'm going to fast forward. So take a listen, Orlando. Make sure that we can hear this. And guys that are commenting, please let me know if the audio is okay with this video, okay? But let's take a listen right now.
While the October inflation data received so far showed a welcome surprise to the downside, these are a single month's data, which followed upside surprises over the previous 2 months. As Figure 1 makes clear, down months in the data have often been followed by renewed increases. It will take substantially more evidence to give comfort that inflation is actually declining, and by any standard, inflation remains far too high.
Okay, so only one report. So far, what we know is inflation's way too high. Let me skip forward because it's just a lot of nonsense. I know it's hard. Orlando. I'm so sorry, brother. I know you already ready to go. This is last part, okay, and then you're gonna freak out, dude. It's bad, but it's not even bad. But okay, so this next segment is 26 seconds. Let's listen.
When will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year. But forecasts have been predicting just such a decline for more than a year, while inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain.
Okay. So, stopping at the highly uncertain, and we'll move on to some of the video. Inflation is too high. Can you unpack that, Orlando?
Yeah, well, I mean, the problem that I have with that is with Powell, the reason why he thinks inflation is going to be stagnant or whatnot, they're not being aggressive enough. Yeah. Every time I turn around, this guy, I've been saying, push it to 1%, he does 0.75. Then in December, the time where most people are spending the most, remember, we're trying to knock down spending. So when December time comes, the holidays come, Black Friday time comes, he goes, well, we're going to do 0.5. What? Now you're taking your foot off of the gas? No wonder inflation is still going up. No wonder a report just came out that said, inflation is went up 2.02%. because you're not putting enough pressure. I say this all the time. Prices will come down when rates go up. And when rates come down, prices will go up. I've done multiple videos of showing actual situations. As soon as rates come down, realtors, sellers, all push to price up because they want the money in their pocket. Realtors want their money in the pocket. It's not that hard of a concept. It's so weird that Powell doesn't know this, but obviously there's some stuff in the background happening.
I mean, so yes, I think that what we're saying, obviously I agree a lot with what you were saying, Orlando. I mean, he's being soft. He's being soft. It feels a little bit too soft. But, as we continue to watch the video, there's so many things that he's saying, underlining that he's saying, that to me, he's also telling the people that are listening, we have pain ahead, right? We have pain ahead, but I think he also understands when he speaks, it has a great bearing on the market. So you may be right. He may be trying to pivot to 50 basis points, but the thing is historically 50 basis points is still a lot.
It is.
But he's also acknowledging he doesn't know what's going to happen next. Things are uncertain. So, and then we only have essentially one piece of data. So, we're going to go into a little bit more of the video where, he's going to go into a little bit more of, the ground that they, basically that they have to make more ground as far as fighting inflation. And I think you're also going to take note, Orlando, that he's going to mention that their forecast is to have a higher interest rates versus their September meeting. He said versus September meeting, we plan on having higher interest rates at a slower pace, right? At a slower pace. But he just said, you guys, we're going to have higher interest rates. But anyways, let's listen right now. I'm going to pull it up. Oh, man.
For now, let's put aside the forecasts and look instead to the macroeconomic conditions we think we need to see to bring inflation down to 2% over time. For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections. I will return to policy at the end of my comments, but for now I'll simply say that we have more ground to cover. We're tightening the stance of policy in order to slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time. Restoring that balance is likely to require a sustained period of below-trend growth.
Okay. So a sustained period of under-trend growth. He anticipates higher interest rates from September, increasing it slower. Can you unpack that, Orlando, please, for us a little bit?
Yeah, so he's basically what he's saying is that we're going to continue to raise interest rates. We want to do it at a slower pace. Who knows what that slower pace is? Maybe it's 6 months to a year. But he's saying he wants to, kind of chip at the whole situation versus coming at it at a, full frontal 1%, 1.2. He doesn't want to come at it that way because they're trying to play this game of not putting us in a deep recession versus, us being at a recession, but not one that's crazy where there's a bunch of job losses. But it's just unfortunate. I mean, I think he knows this, but he has other things going against him. You have other companies, like I just did a video on credit cards. Credit card companies are fighting against him, taking advantage of the high interest rate. You have inflation. In itself, it takes a while to get it to that 2%, right? We can get all the way down to the 5%. Getting to 8 to 5 is not really the big issue. It's getting from that 5 to 2, which is going to be the big monster that you're going to have to fight. And I think he kind of he does understand that, but in my opinion though, and this is just my opinion, I think that you have to throw in some big punches. I think if you just try to jab it, it's not going to knock down the opponent, which is the inflation.
Yeah, man. And I think when I'm listening to this, he's telling us that interest rates are going to go higher than he expected. Again, I understand maybe not at the not at the same period, but Orlando, I want you to do us a favor. Now you touched on something. I kind of want to segue out of the video real quick because he doesn't really cover as much as I would like the unemployment. Now, a great deal of how we're going to crash, the amount of loss of equity, the amount of devastation, a lot of that is going to hinge on unemployment. And I would say unemployment would be a good gauge to determine whether or not we crash land. And I want you to touch in on that, Orlando, because I don't think a lot of people understand what has to break to get to that point. There's so much that has to happen at the top coming down to hit unemployment, to hit the housing market. So will you touch on how hard it's going to be to get unemployment up? Because again, remember, money printing, PPP, they set up the labor market to resist COVID. They set up the labor market to resist COVID lockdowns. So it's going to be super hard, man. And then will you also touch on how right now people are drowning in debt just to afford to live, and explain the credit cards, and then we'll jump back into the video.
Yeah, so not to get too deep into it, but it's to me it is really simple. You have the business to business that normally falls when it comes to the unemployment. That's let's just say Ford is doing business with a car part manufacturer, our mom and pop shop. That corrodes first, right? And that is corroding due to things costing more and whatnot, and then credit being restricted to those business owners, and then business owners using high interest, which is being given to those small business owners, which is credit cards, right? And then it goes to the next factor, which that next factor would be consumers right now. And we are right now seeing consumers use more debt and save the money that they have. If you take a look at the amount of savings that the normal consumer has, it dropped 2 years from 6.26 billion, and now it's down to 626 million, right? I mean, no, I'm sorry, was it trillion? Yeah, it was 6.26 trillion. Now it's down to 6.26 billion, right? That is a huge gap, right? That's in 2 years, it dropped. Now that's getting ate away from inflation. That's getting ate away by people just being able to want to spend more and whatnot. But here's the kicker. Here's the kicker. When that happens, right, and customers are spending so much money on these credit cards and these interest rates, basically using payday loans to pay for everyday purchases. When that fall comes from that business to business corrosion of consumers not buying things anymore, who goes out of business first? The mom and pop shops go out first. They start firing people. Then the big businesses start firing people. But what's going to be left? What's going to be left out of that entire situation? All of the debt that the consumer owes. And that's the problem that I'm going to see. I see a big wave of credit card debt crushing the consumer. Not on top of that, they can't pay it back. What's the first thing that people don't pay back when they lose a job? They're not paying back their credit cards. They're trying to live. They're trying to eat. That's what's going to go first. What happens then? You can't, your credit goes down. Now you can't afford that new home that you've been saving for a long period of time, because now everyone is getting crushed with debt. So I believe that's the tier system that comes down that's going to happen to the everyday consumer.
So, I mean, in other words, it's an absolute nightmare. No one's talking about it. Very few people are sounding the alarm. In Orlando, I don't think people understand how much money credit card companies are making right now. A lot of people are saying they're making so much, man. A lot of people are like, there's going to be credit restrictions. But I believe the reality is right now, the credit card, like we talk about, the credit card companies are making so much money. They're charging 20%, 30%, like we talk about, over 30%. Mm-hmm. It's so profitable that they don't need everyone to make the minimum payment to be profitable. Nope. Will you go into the profitability?
The profitability is credit restrictions right now are at they've loosened dramatically, and that's because credit card companies now are charging 30%, 20%. So now they use math, guys. They use math, and they go to their mathematicians and they're saying, okay, there's 6 people right now. 6 people. We're going to lend to 6 people. And all we need is 2 out of the 6 people to make their payments at these interest rates, and we are still making a 10% profit. So they don't really even care that the other 4 don't pay. That's bad debt that they can write off, and all they need is 2 out of the 6 to make payments, and they're good, and they're still making money. They're still making money. So why would credit card companies help the Fed slow down spending? Why? That makes no sense to them. This is the time where they need to shine and push out more credit to you so that you can spend more. And that's what they're doing. You will see, I promise you, you can look right now. Look, there's deals on getting credit cards, this and that. Yeah. We'll give you 50% off if you sign up for this credit card now. It's because this is a feast for credit card companies right now.
Yeah, I mean, it is, man. I mean, this, we're not even close to knowing that we're, out of the woods here. I mean, there's still so much time that needs to be passed, so much data. And I just want to, we'll get back to the video, but I want to take a moment to explain to our viewers that Orlando and I are not saying that we don't love real estate. I love real estate. Right. I want to own. I mean, it's a great investment, and we're not knocking people that, that love real estate. We're not saying never buy. Orlando and I are saying be cautious right now. There's a lot going on. There's a lot of cheerleading. There's a lot of people maybe you can't trust. Be very cautious when it comes to the largest transaction of your life. Treat it like that. And one thing you may not want to do right now is jump into the market when there's so much dust in the air. If unemployment explodes, what we know right now is we have record high consumer credit card debt. We also know right now we have like almost not historical, but we have like super duper people are broke. A lot of households are broke. We have such a low savings rate right now. It's shocking. So we have the most amount of debt, the lowest amount of savings we've had in so long, highest inflation, most unaffordable, since 1980s. I think Orlando, they're going to keep the rates up, but even if they kept the rates where they're at right now, I don't think it's not going to do anything. It's not going to do anything because it's still going to be unaffordable. The prices went up too much.
And I want to add in here too is remember, guys, the Fed is trying to get demand down. Meaning they want they want no spending. They don't want you guys to go out and continue to buy. That's what they don't want that. But then the credit card companies are giving so much credit out right now that they're saying, please spend. So now we have these two sides, credit card companies providing more credit, loosening credit so that you can spend more. And the Fed saying, hey, look, don't spend more. So where does that end? Does the Fed, this is the reason why the Fed is saying like, oh, maybe pinch, and he's talking in between these lines. He's fighting against credit card consumer debt and them continue to take advantage of the situation and make money hand over fist, right? And then trying to slow down spending. It's a battle that's tough.
And not only that, Orlando, like they design businesses to, like I said, withstand being shut down from COVID. So, dude, it's going to hurt. I don't see any other way out of it. But let's get back to the video.
Yeah.
So let me kind of fast forward. The next part of the video that we're going to watch is going to go into a little bit about the areas of inflation. He's going to go into 3 things. And then I'm going to fast forward and I'm going to hone in on housing services because I feel like the housing services more applies to our viewers. So we're going to start right here, Orlando. And then let's give it a play. And the first part, first part's a little, about 45 seconds. Let's take a listen.
For a sustained period. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into 3 component categories: core goods inflation, housing services inflation, and inflation in core services other than housing.
Okay.
Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex housing has fluctuated, but shown no clear trend. And I'll discuss each of these items in turn.
Okay, so obviously he's seen no progress, right? He essentially said the housing services rapidly increased. Okay, that's important to understand because if he wants to go after the housing market, let me fast forward now, Orlando, to where he goes in more details onto the housing sector. It's right here. And not that this video is not good. I'll have it linked in the description somewhere. You guys can go back and listen to it. But I want to focus on this next part, and it's a little over a minute long. So. And I want you to, if you can, Orlando, listen to what he says about leases. Okay, I think it's very, very important that people are, because rent can't go down. Dave Ramsey just said in every single market since Jesus was a baby, rent has never gone down. Bro, he said Jesus since a baby. He said since Jesus was a baby in every single market. What about like the ghost towns? I'm not even going to go there, man. I'm just so frustrated. I'm so sorry. Let's push play. Let's listen.
Housing services inflation measures the rise in the price of all rents and the rise in the rental equivalent cost of owner-occupied housing. Unlike goods inflation, housing services inflation has continued to rise and now stands at 7.1% over the past 12 months. Housing inflation tends to lag other prices around inflation turning points, however, because of the slow rate at which the stock of rental leases turns over. The market rate on new leases is a timelier indicator of where overall housing will go over the next year or so. Measures of 12-month inflation in new leases rose to nearly 20% during the pandemic, but have been falling sharply since about mid-year. As Figure 3 shows, however, overall housing services inflation has continued to rise as existing leases turn over and jump in price to catch up with the higher level of rents for new leases. And this is likely to continue well into next year. But as long as new lease inflation keeps falling, we would expect housing services inflation to begin falling sometime next year. Indeed, a decline in this kind of inflation underlies most forecasts of declining inflation.
Because he's like, man, because I got Black Friday, I got to do the retail sector, so I got to be soft and dovish. So, can you unpack a little bit of that, Orlando? Will you go into, the rental market? If he plans on, if by listening to that, do you feel like what he's saying is like rent's got to go down? And will you explain what will happen to the housing market if rent starts to go down?
Well, see, this is the tough part, right? The tough part is that he wants rents to come down, but the problem is, as an investor myself, the problem is that you have your expenses continue to go up and up and up and up and up. And so for you to make the same amount of money or even to make a profit on an investment that's in real estate, when you own these rental properties or apartment complexes, you have to tack on and increase the rent. And when you have insurance that is skyrocketing 2 to 3 times more than what it was 2 years ago, when you have property taxes continue to go up 2 to 3 times as well, right? Where is all of that expenses going to come from? Can you charge the same amount of rent when things are doubling and tripling on you? Of course you can't, because that would defeat the whole purpose of the investment. So you have to continue to raise the rents. And it's great that he wants rents to come down, but you have to first control inflation for that to work. If inflation is still high, the market will demand that rent go up. That's just the nature of the game. I don't know about you, but investors, real estate investors, aren't going to sit here and take a $500, $300 hit on every door just because. They're not going to do that. They're going to move with the market. And I appreciate him saying, we need to get it down. We need to get it down. Well, great. Well, then let's slow down these expenses.
Yeah. I mean, Well, I mean, Orlando, if he pivots, how will rents go down? In your opinion, is there a way to get rent down and the housing service is down without causing pain.
No, not at all. That's the problem. That's the problem with this is he wants it both ways. He wants a painless, but then everything go back to normal. But it wasn't. But when everybody was cheering during the bull market and everybody, 8-10 years of just hooray, markets breaking records and houses going, 200 times over 30, 40, 50%. Everybody was cheering then why would you expect it to be a cycle like it's been forever? it's for it to cycle back around and there be pain. You can't have it both ways. It's going to be painful. You have to get ready for that.
And it's a little wishy-washy, but who's going to get hurt the most, Orlando?
I mean, we all know who's going to get hurt the most. It's going to be the individuals who are trying to get a home, individuals who are in the market, especially those that are in poverty. That's going to be the ones who are going to get hit the most. And it's the same old story. It always is that way. And, that's just the way. Could you imagine? Just imagine you're living paycheck to paycheck, and right now an apple is $2 for one apple. Who's going to get hurt the most? The guy who's a millionaire or the guy who's living paycheck to paycheck? It's going to be the paycheck to paycheck person. That's what's going to happen. And it's just unfortunate. But he's, trying to play the game of being politically correct and trying to say, hey, look, we're going to try to make it work, and I'm going to try to make it as painless as possible. But at the very end of the day, he's going to rip off the Band-Aid. It's going to hurt.
Yeah, I mean, and we really don't want people. We understand the difference of a well-leveraged buyer versus a non-well-leveraged buyer. And unfortunately, and this really sucks, most first-time home buyers are not well-leveraged from my own experience. Orlando, I pulled up a comment here. I left it on the screen so that we could circle back to it because I really feel like it's important to address this, especially if there's any first-timers. And you guys, don't forget to go to Orlando's channel right now. If you're not a subscriber on Orlando's channel, go to his channel right now on YouTube and subscribe. I'll have it in the link as well, Orlando. But I want to address this because I hear that a lot. And, essentially the question is how come home prices haven't started going down in Minnesota? But instead of saying Minnesota, I want to just put everyone that is not seeing home prices go down into this category, whether it's Minnesota, St. Louis, wherever it may be, in Albany, New York. First of all, there's only 5 of the 99 top metro areas that are increasing in price. So every single metro area should see this. But I think it's important because not everyone looks at the correct data, Orlando, and a lot of people make presumptions. I'm not saying David is, but a lot of people are making presumptions of the direction of the housing market because they don't see it immediately happening in their local housing market. And that could be dangerous. Maybe it's not. Can you just give your thoughts on people like David that are not seeing the home prices go down, that maybe are discouraged and they're stressed out? They don't know what to do. They don't know if they're ever going to become a homeowner. Will you touch in on that?
Yeah, I think the major thing about this is that you have to, that patience is key. You have to be patient. Just as well as everything went up, right? Everything is going to balance out. So you have to have patience. You have to focus on your local market. I cannot stress that enough. A lot of times people are looking at Austin and being like, Austin's down 20%, 15%. And then they're saying, how come my area isn't doing the same thing? Well, that's Austin. And you live in Florida. Like that, those are completely different market. People want to move to Austin for a different reason why they want to move to Florida, right? That's just what it is. So you cannot compare. That will be the detriment of trying to buy a home when you're comparing two cities in different states on two sides of the country and trying to say, why isn't my property, why isn't my local area dropping like this? It must, you know what? It must be a fluke. The prices will never drop. That is the mistake. So have patience.
There's a reason why people say patience is a virtue. There's a reason why people say that. I think the more patient, the more reward. It's rare that the longer that normal home buyers wait, the better the opportunity. It's a rare situation that something like this would happen in Orlando. We went up the highest amount of home equity in the shortest amount of time. The biggest bubble since last time. Orlando and I are pointing that out. That's when Orlando and correct me if I'm wrong, when we say crash, we are specifically talking about home equity. We're not necessarily talking about unemployment, hypersupply, foreclosure, although we may think those things, that's a different conversation. We're talking about the absolutely insane equity growth that happened in just 2 years that broke pretty much every fundamental of economics, would you say, or any fundamental at all. The whole supply and demand thing, it is a problem. It's a long-term problem. It's we need more inventory. I think we'll both agree with that. But when demand is completely rug pulled, we quite frankly, we don't need as much inventory for us to get more balanced market. My fear, Orlando, is all of this will be for nothing. And the Fed not necessarily pivots too soon, but more money printing. Can you talk on whether or not you believe that things might get so broken, people might be in so much pain that the Fed will have no choice? Both parties will come together. We have a divided government. Both parties will come together and start printing money again. Can you talk in on that?
Yeah, I hope that's not the case. Because that's not fixing the issue. That's you seeing and go, oh, it's I try to akin it to like if your kids do, they're crying, and instead of to stop them crying, you just give them pieces of candy all the time so they can stop crying, but they never really learn the lesson. And that's what I'm hoping the government doesn't do. We've already printed so much money, and we see where it got us, right? So why would we go back to the well, print more money? Because if we do that, I honestly believe if we do that, all we're doing is kicking the can down the road so that we can have a more destructive, possibly a depression, if we do something like that. Because it cannot, it cannot. The system cannot continue. It is not. This is capitalism, guys. I know a lot of you guys may not come to terms with it. This is capitalism, and unfortunately, everyone can't be rich. Everyone can't. And if the government is going to continue to print money, good riddance to the value of our money. Inflation is going to shoot through the roof. What's going to happen then? Are we going to continue to raise rates till they get to 30%? I mean, where does it stop? You print more money, get ready. Get ready for the bottom to fall out.
And let's hone in on that, because that's super important, Orlando. And that's why I have this question on here.
Right.
Now, this is from SK. This is the nail on the head. Okay. And I've been constantly saying this. Everyone wants to own their home. Okay. So demand will be there forever, right? That's what I'm saying, you guys. This was a demand problem, not a supply problem. Everyone wants to buy a house because they're, who doesn't? It's our right.
Yeah, of course.
It's a very wise decision. So everyone has always wanted to own their property. Here's what happened. The Federal Reserve released the floodgates of demand. It doesn't matter even if we had 2 million active units, that demand was so crazy, the 2 million units would have been gone in the first year and a half, because they had not 2% interest rates and the free down payment in the form of stimulus. So people got a free down payment and a 2% rate. And the same thing with 02 to 08, when they deregulate lending standards. That's why they had to pass the Dodd-Frank Wall Street Reform Act. When they deregulate lending standards, everyone's going to buy a house. It's so crazy. I'm so sorry I rant sometimes, Orlando.
I'm working on it. I'm just saying that, at the end of the day, do you think if we get back to 2%, do you don't think there will be a ton of people in line to buy a home? Of course there will. Especially if what you were asking earlier, if they print money along with a 2-3% interest rate, we're going to be right back in that same bucket. And that's what we should avoid.
Yeah. Do you think that because we don't, neither one of us wants to get political, and we won't, we're simply talking about housing market. And unfortunately, can you talk a little bit, Orlando? Everyone knows we shouldn't, but are we capable? Right. And I'm not talking about, are they going to flip flop? I'm saying, can Americans handle the breaking? And let me say this real quick. a lot of data says that American households can take a hit on equity, not living expenses. They could take a hit on equity. So I'm all over the place, man. There's so much to say. Can you go in on? Can you talk a little bit on that?
Yeah, I mean, can we take a hit on equity? Of course we can.
Yeah.
Equity has went up, in the past 2 years more than it has ever, right? So of course we can take a hit on the equity portion of it. That's really not the question. The question is really what's going? Can the normal can the American take the punishment that's going to come after that? Right. We can take the hit and the equity can be, go down to, maybe everybody has 5% equity on their home. Right. And it dropped from 40 to 5. Right. They take the hit, but can they take what's going to happen after that? Mass unemployment, inflation, super high. Can you take all of that stuff? And my viewpoint is no. Most people
I don't
will
think so.
point the finger and blame and say, this is horrible. Why did you put us in this situation? So no.
And we're not saying we agree with that mindset.
Right.
We're not saying, and I'm glad you understand that as well. Let's go into this question, Orlando. And how much time do you have, man?
Yeah, I still got about 20 minutes.
Okay. So, I'm not 520 gal KO. That sounds like an MMA fighter. I wouldn't mess with her. If I mess with her, I feel like she's from the 512. I don't even know where that is, but she's going to KO me. Great question, though. Good point. I probably took that completely wrong. And I agree with what she's saying. I think you would agree. I don't think everyone understands, Orlando, how near impossible it's going to be to get 2% inflation without destroying many things in the economy. So new normal will be set likely around 4%. Do you feel that's accurate?
Right. I do think that's accurate. I mean, like, as far as getting inflation down to 2%, man, it's going to be so tough. He's going to have to make, some big change, like I said, it's going to be tough to jab your way to 2%. It's going to be tough.
Yeah. And in order to do it, you got to gut people, man, like good people, like stuff that's not fair. You got to destroy the labor market.
Yeah.
All that
you
work. You got to destroy the rental market, all of the, and I'm not, all right, institutional investors buying entire communities, turning them into rentals, SFRs, I think it's a problem, but I'm talking about the mom and pop shops, man, that are good for their tenants, good for the community. They're not doing Airbnbs. I mean, those people are getting crushed, man. I mean, it's sad. It's pretty sad. So here's another question here from Peter, essentially talking about loan limits. Conventional loan limit also went up. A lot of people are saying that, we can handle it. The loan limits are going up, but the thing is, Orlando, we still have the Dodd-Frank. You guys, listen to me carefully. We still have the Dodd-Frank Wall Street Reform Act. It's a law, piece of legislation. In that law, there's something called qualified mortgages. Qualified mortgages protect the lender from a lawsuit if someone goes into a foreclosure. In order to have a qualified mortgage protection, you can't lend on anything over 30 years. And you can't go stated income, right? You can't just make up your income.
Yeah.
So, the lending standards are just as rigorous for the most part, as they've ever been. They are loosening up the loan limits, but can you talk, because I know you're in commercial lending, but not as much residential, but can you talk on your thoughts on what impact you think that raising maximum loan limits will have on the market in whole?
Well, I mean, I don't think raising, first of all, it's only in certain areas, right? California, some of these higher priced areas. But I think the main key of that is if the interest rate is still high, then it doesn't really matter what the loan limit is. I mean, to be honest with you, the loan limit portion is just to make it easier for banks. It's not for really the consumer. You know, so the raising of limits is just so that the mortgage is backed by the government, so that if anything happens, that the bank can get off easier, right, or get their money back. So it's not really for the consumer, and it really doesn't. If you can't pay 5%, it doesn't matter if the loan amount was raised on FHA or not. If you can't pay 6, 7, 8, whatever the interest rate is, it doesn't matter. So I don't think that it really makes that big of a dent. What I think it should raise the alarms on is why is it that the government is allowing that the limit be raised? Why is that? Why?
Yeah.
You know, that's the question that should be asked.
I mean, hopefully it's not because they're going to pivot and change the laws, but I mean, $1 million for an FHA loan, like FHA loans are were made to make affordable housing. But I get if you want, I don't know, man, but $1 million loan amount for FHA, to me, it's like, I love what you just said. It does make it easier for the lenders, for the consumer. I can assure any of our viewers that if you can't qualify for a $500,000 house, you can't qualify for a $600,000 house. So the loan limits, it matters a little bit to a small amount of people, that maybe they can't go into a jumbo loan and get an extra like 10% down, and they want to stay in conventional to do 5%, or FHA to do 3.5% down. But, you know, guys, pay attention to, you know, what's happening, the job loss, the layoffs, the inflation, the quantitative tightening. You know, more than likely, it's just, I mean, let me ask you this. Do you see lenders, mortgage lenders into 2023 being more restrictive with their guidelines? And I'm talking about residential mortgages.
I would say yes, for one. I would say yes, they are going to be a little bit more restrictive. And that's because you guys probably don't read all of this stuff, is that a lot of these Wells Fargo, Bank of America, all the big guys, they shoot out these forecasts that they don't really share with everyone. And their forecasts that they say are all 2023 is just doom, gloom, recession here, recession there. And so they're all going to work together to restrict when it comes to their credit limit, so they can protect themselves from foreclosures and workout loans. So I do expect 2023, these guys, all the banks are going to restrict. You're going to have to prove that you're not going to lose your job, that you've been working there for 2 years, that there's basically no chance of you losing your job. If you're, you know, some of these banks, instead of looking at 2 years, they're going to look at 3 years worth, or 3 to 4 years worth of tax returns, just to make sure that we are not going to run into any trouble that you will foreclose, that we'll have to foreclose, or you're going to lose your job. That's going to be the main thing. You're going to get 4 to 5 calls from the beginning of the transaction all the way to the very day that you close, to make sure that you're still working there. It's going to be tight.
And man, sometimes when you feel like you have an epiphany, like when all the data finally connect, I just realized something, because at first I was like, maybe a little bit restrictor, but it's already so restricted. DTI and the underwriting and verification process for residential, insane restriction. So, but here's how I could see even more restriction: if the loan modification departments get inundated with people in default. Right? Because these houses need to get people paying their mortgage. If these lenders, because loan modification is working from the data. Loan modification is working. On average, people are in their house, from the last data I looked at, roughly 1,200 days before foreclosure. And that's all fine and dandy when there's not a whole bunch of people in serious delinquency. When a whole bunch of people start being in serious delinquency, and these loan modification departments can no longer afford to be nice, I can see them saying, well, hold up, we got this back end problem. We can't handle this front end business. Right. So, but
let me tell you this is that on the secondary market, which you guys can't see, the secondary market, bundling mortgages together, it's not a very profitable thing right now. So most of these banks, they bundle loans together and then they ship them off to Wall Street and they sell them, and you get a yield spread over it. It's not very strong right now. So a lot of these banks don't have an incentive to even give to loosen up credit restrictions and allow a bunch of credit to be bundled up and being sold, because they won't make any money from it. And here's the thing, a lot of people think that Bank of America, all these other guys want to service the loans themselves. They don't. They don't. They want to bundle them up and give them to some Wall Street guy. That's what they want.
Yeah. So I have a question, and I agree with that, man. I mean, and the thing is if they hold on to the money, they can't lend anymore. They run out.
Right.
So they have to sell it.
It's not infinite money.
There's not infinite money, so they have to get it off their books so that they can even lend more money. Take a look at this comment, man. I didn't do a video on this when it came out, but I definitely commented a lot about it because But what she's asking is, so Bank of America came with this new loan, 0% down payment. Obviously, as a residential loan officer, I know there's grants and bonds like for days, right? Grants and bonds to help people with zero down. And actually not even zero down. There's many programs that will help people with the down payment, with money.
Right.
So, to me, it's nothing new, but can you, because I know you've done a lot more research on that program. Can you talk into that program?
Yeah, I mean, B of A, they came out with a couple of programs where they have one where it's just like a zero down payment, and then they had one that was based on like minority communities, like Black and brown communities, and it was in certain areas and whatnot. And so my point about is that I just for first of all, Bank of America is kind of a shifty, shaky type of bank, just to put it out there. I mean, and it's not because this is my opinion. I mean, there's settlements over and over and over with Bank of America saying, discrimination and appraisers and all that other stuff. It just goes on and on and on. But my point is that they came up with this program that they're trying to win back the trust of the consumer by coming up with this zero down program. And my thing is that it may sound really great that you're going to get a zero down scenario, but you have to remember the type of home that you're buying. You're getting zero down on an overpriced home, right? So, the thing, and I know a lot of people think to themselves, the $20,000, $10,000, it may be too much or whatnot, but just think about this, is as soon as the market hits the fan, as we've seen the market is currently going down, if you would have bought in at 0% and bought that overpriced home that was $50,000 over, you would be under right now. You would be under.
Yeah.
At zero down, you would be under.
100%.
And where does that put you? Does that put you in a situation where you feel like, oh man, like you what if you lost 20K on a home? 20K. Now you're underneath 20K. You can't refinance. You can't do anything like that. You're just stuck with a loss. So I always believe if you're able to put money down, then go for it. I understand there's programs that allow it. Even the grant programs that you were talking about, Real Estate Mindset, is that I would go and try to approach something that puts money down. And I understand the VA loan does zero down too and whatnot, but in this market, it's very tough for me to be like, hooray, zero down. It just puts you in a bad position.
Yeah, and not to mention, Orlando, I mean, being on a more realistic side, it takes 8% to sell your house. You guys listen to me, okay? Before we start even talking about house price decline, real estate's not liquid, all right? In order to sell it, it costs a whole bunch of money. I think it's unrealistic, but up to 8%. You got 3% commission buyer, 3% commission seller, roughly 2% in fees, counting, taxes. You got to pay taxes. It's crazy, dude. Right. Let's talk about this. I left this question up because I have you and you're very knowledgeable, especially in the commercial. So first of all, let me explain that not everyone that gets a HELOC, actually the advantage of a HELOC is you don't have to take out the money right away. It's almost like a credit card that's attached to your house at a super low interest rate. So a lot of people are getting HELOCs just to have for an emergency. Right. And I don't necessarily, for the well-positioned homeowner, I don't necessarily think that's a bad thing. So I just want to explain that. But touch on the fact that, talk about the people that are using their HELOCs, Orlando, to flip properties right now. And talk about if you think, So talk about that, if you would. And again, real quick, one more thing. It has to be your primary residence. I believe, is that
so
that
you
have
correct.
put a HELOC on you have to put your personal primary residence into the deal to get money to invest in real estate. Just FYI, Orlando, please.
Yeah, there's some people. I don't. Well, let me just kind of go back and say, like, in the last 2 years, there's been some really creative HELOCs, right? Normally, with the old HELOCs, not the brand new ones, but the old HELOCs, you had to be in the home at a certain amount of time before you could actually get the HELOC. So let's just say it was 2 to 3 years that you had to be in it. But since this run up, a lot of banks have said, oh, you could be in the home for 1 year, and in some instances 6 months. It'll just be a higher interest rate, so you have to pay a premium, right? But now those same individuals are in a world of hurt because let's say you bought in Austin, right? And you bought in Austin and you bought at the highest point, and was a 50, 60, 70, $100,000 over asking, and then it went up even more from that point, and you put a HELOC on it. Now, as prices drop 20%, you're at a negative and you still owe this money. So you're at a loss, but yet you have you still have this HELOC out there that you spent XYZ money on. A lot of people took that money and invested it inside of their home by doing, new appliances, flooring, painting, building a deck, whatever it may be. At the highest time, a deck that would have cost 2 years ago would have been $10,000. Now it's $20,000. The labor is 2 to 3 times more than that. The materials are higher also. So everything's inflated, and that money that they use in the HELOC has just evaporated. And now the pricing of their home didn't even go up with that. It's went down. So yeah, that's a tough one.
I don't know if everyone understands what's going on, Orlando. What? Pay attention. And I'm not going to knock any of your viewers. What I've noticed is, and this is my own opinion, the people that are coming to YouTube are generally, in my opinion, they're just better off people. They're a little bit more knowledgeable. Now, I know I'm not saying listen to every YouTuber's financial advice and follow. Do your own decision making. But what I've noticed is people go to YouTube to empower and to learn and to educate. So. Very good thing. I want, if you have a little bit more time, this is a good one. Not about the interest rate, but this is her question. What's the VA interest rate? First of all, I know a little bit about that. Generally, the VA interest rate is going to be lower than conventional. I don't know what it is now because it depends on criteria and approval parameters when it comes to the pricing of the interest rate. So the next thing, though, that I really want to hone in on is assumability, being able to assume a loan. Now, I put out an article a little while ago just trying to explain that the seller needs to be released of liability, and people were like, oh, you don't understand. I had a dude, I don't even want to use their name, but I mean, the guy asked me, he doesn't realize that how many investors that we know. Like, thank God that you yourself could see past your nose. I just want to give you props on being a great human being, Orlando, and still a great investor as well. A lot of people lose the human being and empathy when they start making money, and you don't. And that's why I'm constantly around you. So talking on assumability, you may not know a little bit about it. Do you think being able to assume someone else's loan to get a lower interest rate to purchase, we won't talk about the down payment requirements unless you want to, but do you think that is realistic, understanding it's a different process than it was in the 80s and 90s? Can you talk in a little bit?
Right. The problem that I have with assumability is that you have to get a seller to agree to that. And I can promise you this. If you go up to a seller and you say, well, I'll buy your house. Now, this is without them putting it up as a selling point, right? You go to a seller and you say, hey, you got a VA loan. Can I assume it or whatnot? No seller wants to really go through that process. It is not an easy process of just signing over here, signing over there. It's an entire process, and no seller wants that. Most sellers just want to go through the process of just selling their home. You deal with your financing, and I deal with my liability when it comes to my financing. I don't have anything else to do with what you're doing when it comes to financing. That is, it's like going up to in the investing world and trying to get someone to do seller financing. Like, that's what it's like. It's extremely hard. And the only way that I have seen it really work is if the realtor uses it as a marketing tool and says, look, my seller is willing to give you his assumable loan at 2%, whatever it is. They're putting it out there that they're willing to do that, right? But for you to go find a property and then just throw it on the seller and say, hey, you got a VA loan. Can I go ahead and assume it?
Yeah.
It's not happening, man. It's
Yeah,
not.
yeah.
They'll move on. They'll move on.
Yeah.
They will take, I'm telling you guys, a seller, rather than doing an assumability, they will take a little bit lower in the amount not to deal with it. They just will.
Yeah. I mean, and I'm glad you said that. And I just want this last question. I'll let you go, Orlando. I don't know if you have time, but the thing is assumable loans, if you're a super savvy investor, you know where the links are, you know where to get a concentrated amount of data, right? Where people are willing to desperately leave their house and give you an assumable loan. I mean, but the thing is my point I was trying to make, Orlando, is I'm not saying it doesn't happen. I'm just saying, like what I think you pointed out, it's not practical to the normal person. Assumable mortgage, it's not, and not only that, it could take 45, 60 days. And a release of liability must be given on addition to the assumption. So the buyer has to get approved for the assumption. Now, after they're approved, that the seller's still liable. So if the buyer is late on the mortgage, it could hurt the seller. And who in their right mind is going to do that? So in order for that not to hurt the seller, unless someone's incredibly desperate. And that's what a lot of the investors do, is they take advantage of the desperation. But unless that lender gives the seller full release of liability, it doesn't make sense. So I just wanted to end, Orlando, because we were talking for 56 minutes. I really appreciate it, man. This is a little bit of a treat. Let's end here. And the reason I want to end here is I want people to understand how much knowledge and expertise you have, especially and I know that a fourplex isn't necessarily commercial residential, but Orlando, you're an absolute genius. Especially when it comes to not only residential, but commercial building lending. You're a huge resource. Can you talk in and can you answer this guy DL's question about what it will take to have a fourplex built, and answer that in a commercial lending way? So it's an 8 unit.
Well, I mean, I'll answer it in just in general. Just as a residential. The point is this. Yes, you can build a fourplex, but a lot of times what people don't really understand is that to build anything, no matter if it's a single family, a duplex, or a 20-unit apartment complex, first you got to find the land, then you got to get it zoned, and then you have to get it approved with the city, and those are ridiculously hard things to do, especially by yourself. So what do most people do? Most people get firms and whatnot to do that for you. And that costs hundreds, sometimes $10,000 to $20,000, $30,000, depending on the size of the building that you're doing, to get that approved. And sometimes it just doesn't get approved, but you still have to pay that money. Then once you get that all done, now you got to go and pay for things like all the rough end stuff, all the piping, sewer, easements, all that other stuff, right? And here's the problem. I would love nothing more than to go buy a piece of land and build a property. But right now, currently, it is cheaper to go out and buy a property that is existing rather than spend the money and the materials and the labor to build a property right now. You will not make any money. You won't. You just won't. There is barely, at any of the major markets, it's going to cost you an arm and a leg to do any of that rough end work, buying the land. The land would probably be the most cheapest thing, but the materials that is going to take to build it is going to be out of this world. It is 2 to 3 times more than it was 2 years ago. So are you going to charge 2 to 3 times more in rent? You can't. The market won't hold it.
Jerome Powell's trying to get rent down. You're gonna fight the Federal Reserve right now and buy an overpriced house? Come on, man.
You can't. So what I've been seeing is apartment complexes that have built and they got approved and they went ahead and threw money and built their apartment complex. I just spoke to a gentleman a $26 million apartment complex, right? They're charging 1 bedrooms are, $2,600, right? Totally above market in my area, in the St. Louis area, totally above market. But they have vacancies. They have vacancies at 30-40% because they're so high. But the problem is they have to charge that, because if they don't charge that, they lose. They lose. And I know what some people would say. Some people say, well, it's rather lose $10,000 than $100,000. Just get people in there. But a lot of these developers don't believe in that. They believe once they start the cycle of giving low rent, the rest of the apartment complex is going to want that lower rent. Imagine you paying $2,600 and then you see your unit next door to you is selling for $1,000. You're going to be like, what?
Yeah, you're gonna be upset. You're gonna be. You don't want to upset people in their houses, man. You don't want to put neighbor after neighbor like that. So Orlando, real quick, guys, let me just talk to the viewers. I really appreciate all of the question, guys. I really appreciate all of the support. Now, do me a favor, before you end this video, don't leave the video. I'm watching the count. It's going down a little bit. Oh, it went up. All right, thank you. Don't leave the video before you leave, guys. Go to Orlando Miner's channel. Right here, Orlando Miner, go to his channel. This man is a genius, huge inspiration. We're part of a group. We talk often. He helps me all the time with not getting burnout. So go to Orlando's page, show him some love. Orlando, before we go, man, and we're right at an hour. Do you have anything you want to say to the viewers before we go?
Yeah, I would just say, please, guys, have patience. It's going to work out. Make sure you look at your local area and, continue watching me and Real Estate Mindsets channels. We update you guys on everything that's happening with the housing market. So I really appreciate, man, you allowing me to come onto your platform. And I love you, brother. I really do.
I appreciate you, man. I appreciate you definitely. So other than that, guys, we'll see you on the next one. And we both wish you luck out there.